Awesome. Thank you, Jessica. It's great to be with you guys today. And it's important for us to be able to get to know a bunch of our neighbors and our constituents in the greater Atlanta market. Atlanta specifically has been a really important table stake market for us as we've grown our business. And I thought it'd be helpful today if I spent a little bit of time giving you guys an overview of what the single family rental industry is, and where we've come from, and why the topic of single family rental has been such an interesting one in the media over the last 10 years. And I think it's important to understand that really kind of a couple of things. And Christy, you may want to, the formatting, I don't know if people are seeing it the same way I am, but if there's a way to make that slide bigger, I'd put it into presentation mode. But anyway, while we're kind of sorting all that out, taking a step back, people have rented something in this country for hundreds and hundreds of years. If you look at the country today, it's pretty simple as we explain it to folks, and you think about who owns versus who rents. Basically, 2/3 of the country owns something in some way, shape, or form, and 1/3 of the country leases something in one way, shape, or form. And that 1/3 group represents roughly 47 million households. So you basically have 47 million households in the US that rent in some way, shape, or form. Of the 47 million, basically 16 million of those are single family detached product, which is our segment, or what I would call our sector. Within those 16 million, less than 2% of the 16 million, so call it less than 300,000 homes, are professionally managed by property managers like ourselves, where you can offer a suite of services and a structure that look and feel like any of us would expect if we were renting from one of the big multifamily companies. And there's a reason for it. It's always been a mom and pop business. It's always been a privately held, enterprise type of business. And by the way, 98% of it today still remains as such. But if you go back to 10 years ago, there was an entry point or a price point that made a lot of sense, that allowed for people to come into single family rental in a way that was meaningful, where you could build enough scale and density of product that you could actually offer these services at an affordable price. And that's how Invitation Homes was grown. My background was in single family, multifamily, and a little bit of manufactured housing. And we had done, about 1,000 single family homes in the Phoenix market in 2008 and 9. And we thought, this is a replicable, you could replicate this business model across what we viewed as some of the most attractive MSAs in the country, with Atlanta being one of the foremost of those. And you guys know your MSA better than anybody. Atlanta economically is diverse. It's diverse in terms of, the people in the marketplace, the type of commerce it has. I think more Fortune 500 companies than anywhere else outside of New York City. And so Atlanta was a very important, part of our strategy as we started to build out what we would now become the largest professional single family rental company in the country. And today we have over 80,000 homes in 16 markets, as you see right in front of us. And we employ about 1,200 people, about 150 employees in the Atlanta market alone. And if you think about our business, we do almost $2 billion a year of revenue, just shy of that, about $1.8 billion. And our business is pretty simple. We try to create quality housing, fantastic locations that are near to, important job centers, transportation corridors, things like that. I'll talk more about what that means for us with our approach to Atlanta specifically, but making sure that we anchor in on school districts and amenities and things like, in your market, for example, in Atlanta, pool and tennis is a big thing, right? A lot of your HOAs, a lot of communities have pool and tennis. That's one of the things that differentiates Atlanta from even some of our other parts of our portfolio in the country. But I think more importantly, we want to be where rooftops are forming. We want to be where families are thriving and growing. We want to be a good neighbor. We've spent, and I'll get into some more of the specifics around Atlanta, but nationally, guys, you think about our business. Today we've got about a $20 billion market cap. We're publicly traded on the New York Stock Exchange. Our ticker is INVH. And our business is pretty steady and stable. We run between 97 and 98% occupied. Our renewal rates are typically around 70%. That's been better over the last year and a half because people are staying with us longer. We've seen that trend over the last 7 or 8 years. But our goal is to create an experience that people want where they can be down payment light. And as you think about, and I'm sure we've got a variety of people listening in today to this conversation, you know, I'm a homeowner. Some of my siblings are homeowners. Some of my siblings aren't homeowners. Some of them prefer to lease. We want to fit into that sweet spot for folks where they want to be in certain neighborhoods, but they don't want the burden of homeownership. So we'll take care of the costs associated with that. But they want the same experience that you or I would be having in a traditional single family home. Christy, would you mind going to the next slide? A little bit more about who we are and how we've been in Atlanta. So we came to Atlanta in May of 2012. We still own the very first home that we bought there. I've spent in helping build this business probably more nights in Atlanta outside of any other market historically because of A, its size, B, the opportunity that we have to be active in your community with some of our preferred partners on our charitable effort side. You'll see Operation Hope. John Hope Bryant is a dear friend, and we've done some tremendous work with them, also with the Atlanta Community Food Bank and Action Ministries, to name a few. We're very active in the Atlanta market. It's our largest market from a home count perspective with 12,500 homes. And we've invested nearly $2 billion in terms of purchasing homes. I think the important thing to understand about us, on a yearly basis across our portfolio, after we've already owned homes, we spend about $400 million a year in renovating and updating and enhancing community standards. In Atlanta alone, in the last 9 years, we've invested $391 million just improving our homes and doing things that are going to continue to lift values in those neighborhoods and create a better experience. We're a big employer in your market, as I mentioned before, with nearly 12 million in salary and benefits across our employee base. And we own and operate in markets as far north as Cherokee County, and I can't remember what that name of that great lake is up in northern Atlanta. We're not that far north, but we go all the way up through Fulton and as far north as Cherokee County, and then we're also as far south as Clayton, DeKalb, and Cobb, and parts of your market where people are looking for quality housing that will fit their needs and standards. Our average resident in Atlanta today is about 40 years old, has a combined household income of roughly $95,000. Typically, that's two wage earners. We've got, a mom and a dad, a partner situation, whatever it is, cohabitating and living in our homes, and they've got somewhere between 1 to 2 kids. And 9 times out of 10, as we look at the survey data, we survey everybody when they're moving in, and we try to survey everyone when they're moving out. When they respond to our surveys, we learn a lot. They're looking for things like school districts. And you guys know, in Atlanta, school district is everything. The zip codes really matter, right? In terms of which school districts and why. And I learned that, 10 years ago, as we were starting to invest capital in your market, is that you really want to hunker down and make sure that you're supporting local schools through your community efforts and outreach. But more importantly, as you guys know, I shouldn't say more importantly, but equally as important, home values tend to trend where some of the best local public and charter schools are available. And so for us, we believe strongly in understanding those appropriate points and making sure that our impact in the communities where we operate are active. And we're very committed to your MSA and to your marketplace. We love the diversity of it. We love the diversity of thought. We love the fact that it's a diverse economy and an economy set. You've got companies like Coca-Cola alongside companies like Chick-fil-A and everything that centers in and around Delta and home building. I mean, it's just a fantastic, you guys live in really one of the best markets in the country. And we're grateful to be a part of that market as we consistently find ways to grow our business. It's important to understand how we operate within your market. So I talk about 12,500 homes, but what we do across the 130 employees that are in Atlanta for us, we kind of operate by segmenting our homes in what we call a pod. And so it's geographically spaced and located. And a pod will usually consist, I think in Atlanta, it's a little over 3,000. It's about 3,200 homes per pod. And that's operated with, call it 12 to 13 people in the home office, which our home offices are right off the 400 there as it heads north. We've got a local office presence in Atlanta. And then we also have maintenance, full-time maintenance techs in the field. You might see some of our vans driving around there. They're kind of a cool looking logo that's green. It says Invitation Homes on the side. And so we'll do about half of our work orders in-house from a maintenance perspective, and then about half we'll outsource. We're not going to have our folks get on roofs or get really up above 10 or 12 feet on a home. So think about, call it the heavy mechanicals, HVAC roof, heavy plumbing, that we're going to outsource with local vendors. We work with over 170 local vendors in your market. We keep a lot of small business owners very busy in our vendor management business. And in addition, we're constantly looking for ways to be able to invest more in your market. And when we buy homes, on average, say a $300,000 home today that will rent for about $1,800 or $1,900 a month in your market, we're going to put another $20,000 or $30,000 into that home up front. Not only to lift the cosmetics, the fit and feel, and the finish of the homes, whether it's, luxury flooring, upgraded kitchens, updated master bathrooms, but we also want to make sure that we're doing the small things that create energy efficiencies and also make this a worry-free experience for our resident. So namely, goofy little things like supply lines underneath every sink. We're going to replace those. They're 20 cents a supply line, but you should just do it up front. T lines, toilet plates, like all the stuff that can create, reoccurring maintenance issues for folks. We try to get ahead of all of that up front with our vendors. And we have terrific vendors in Atlanta. It's a great market. We've worked with, I'll just say one more thing on this slide, Operation Hope, in doing things specifically in Atlanta to create opportunities for minority-owned businesses, and also to come in and actually teach small business owners how to be able to expand their businesses to some degree so that they could also participate in the scale and business opportunities with our company as well. Next slide, Christy, if you wouldn't mind. So we just go to like a little bit more about macros. And I think you guys are probably experiencing this in Atlanta as well. But as you think about where shifts in demand are going, and I was talking with one of the gentlemen before from the Atlanta Economic Club on this, we've been underbuilding supply for really the last 10 years. Now go back to 2007 and 8. If you look at the supply fundamentals in the US, we should be delivering somewhere around 1.5 million new units every year, year over year, just to keep up with normal household formation. So what does that mean for Atlanta? You guys, much like a lot of our other markets, I'm from Phoenix. I was born and raised in Phoenix. I'm talking to you today from Dallas, from our corporate headquarters. But these markets are all very similar in that they're high demographic footprint markets where we're seeing a lot of incoming growth, right? In Atlanta, you guys are getting transplants that come into your market, year over year. Texas, Dallas, Houston, the same way. Phoenix, very much the same way. And if you look at the way that our portfolio has been put together, we've really focused on being what we call the smile markets, which are the markets that are high growth, Sunbelt markets that are, generally inviting to demographic growth and household formation. Well, if you go back to 2008 and 9, what happened was as builders continued to lean in and continued to lean into the crazy amount of, call it demand and home buying that was happening in the early 2000s, we overbuilt. So did building supply folks. And so that created a lot of drag and scarring. A lot of us felt it, myself included, in terms of different types of real estate that we own. And so we had an overbuilding scenario. And I think what happened based on the last housing crisis, we've had really careful growth, both from our public and private builders, as well as our multifamily developers. And I think most economists would tell you that somewhere in the last 10 years, we've undersupplied U.S. housing by somewhere between 2 to 4 million units, depending on whose opinion you're listening to. Well, that's a big challenge. You can't make that up overnight. And so you couple the low inventory in the U.S. with the fact that we've got a millennial cohort of, say, 65 million people between the ages of 22 and 38 that are coming into really the sweet spot for ownership or rental. We're going to, and let me pause, couple that with the fact that interest rates have been in the floor for the last 3 years. That's a perfect recipe for the home price appreciation and the accelerating demand figures that we've all seen together over the last 5 or 6 years. It's not a surprise to me that we're seeing the type of demand that we're seeing, not only in our business, but across really the housing spectrum. And so you start to think about, well, what are people choosing and why? Why are people starting to show more of a preference for renting a single family home than maybe ownership. Now, I have no illusion that 2/3 of the country are going to always own. I'm a homeowner, for example, but we are always going to have a percentage of the population that for a variety of reasons choose to lease. And we see it really across three buckets in our business. The first is that we have people who just need the size of a single family home. And on a per square foot basis, it's much cheaper to rent single family than it would be apartments. They want the garage, they want the yard. Maybe they can't afford ownership necessarily, but they want the school district and they need that type of space for their family. That's about 1/3 of our demand. The other 2/3 could absolutely own a home if they wanted to, but they fall into kind of two categories. The first is a group that we call transitionals. They're transitioning. They've had a job change. They've had something kind of happen in their life or whatever, and it's caused them to want to lease for some period of time. That's about 1/3. The other third is what we call preferentials, which is this millennial cohort that I talked about earlier, and or including people as old as some of the booming population. We got a lot of boomers that rent from us, or they rent a second home because they want to be near grandkids. They want to be near things that are important to them, but they don't want the burden of either ownership or additional ownership. And so I'm not personally surprised that we've seen, as you look on this chart here, the amount of people, call it 16 million plus, that are looking for a professional leasing experience in the US. And that will, we believe, based on our own research and the fundamentals that we track in our business, that will likely continue to grow. And in our resident surveys, they show this they show this kind of preference in our feedback loop. And we're certainly seeing some additional tailwinds due to COVID-19, but we saw all this leading up before the pandemic in terms of the demand and the amount of demand we were seeing for our product. You know, it's funny, John Burns, who's one of the big economists that track a lot of what's happening in single family and in US housing, has a statistic that I think is really impressive. And it's going to be equally impressive for you all in Atlanta as you think about some of the opportunities that are going to come to your market that are outside of housing. You already have this robust employment base with some of the best companies in the world, literally headquartering out of Atlanta and continue to invest in Atlanta. But the population of our country continues to move on a median basis, meaning on an average basis, the population of our country continues to move a foot south every day. That's very meaningful for markets like Atlanta and where you think a lot of your growth opportunities are going to become. Atlanta is one of the great markets in our country, and you guys are well positioned to capture a lot of that growth going forward. Christy, can we go ahead and maybe move to the next slide? So this is just to touch on, you know, what I've talked about in this decade-long shift of people moving maybe from suburbs to city centers. We've started even pre-pandemic to see a little bit of a shift for people wanting flexibility and a little bit more space. You know, this data in front of you shows kind of what's happened over COVID-19. Now, to be totally clear, our first priority as a responsible owner of real estate and as a good company was to make sure that we looked after the health and safety of our residents. We've helped today over 3,000 families restructure their leases, helped with forbearance, eliminated debt for those that have been truly impacted from COVID-19, and also the health and safety of our associates, I might add. We're a very high-touch company. We run a system called ProCare, where we go in and out of homes every 6 months to make sure that the diagnostics on our home are in the right and proper place for our residents. But we also want to be high touch with our associate experience, which includes things like smart home technology and all of this. That drastically changed for us with the impact of COVID-19. And we went immediately to doing as much of our work virtually as we could. We worked really hard to provide assistance to residents that suffered financial hardship. We're still doing that today. We've, as I mentioned, been able to help several thousand families through that process, both on things that we can directly do and also, in addition, guiding them to programs that are available to also help them through this difficult time. And, despite kind of the initial uncertainty of what would happen around COVID-19, and we were as curious is the wrong word. I'd say nervous, curious, scared for our associates, our residents, as we could be. We'd been pleasantly surprised for the amount of demand that not only stayed in our business. So going into the pandemic, we were 97% occupied, but we've actually seen a bit of an acceleration for people looking for more space. We believe that the work from home component, which is now, a big part of how employers and employees are thinking about lifestyle, that will continue to be a net tailwind for our business as we offer bigger spaces generally than our multifamily peers. And we offer an experience that's flexible in nature. We think that those tailwinds will continue to support our business. And while the pandemic, likely pulled forward a little bit of demand, we would still expect that demand is going to stay really strong, in part because of what I mentioned before. Housing supply is going to stay relatively tight for the next several years, especially in high growth Sunbelt, Southwest, Southeast markets. Christy, would you mind going to the next page? So what does this mean, really for our industry and for Invitation Homes? As I talked about earlier, as you think about what's going on in housing generally, and you think about that imbalance between supply and demand fundamentals, there is a massive amount of demand for single family, affordable, flexible housing. There is a tremendous amount of capital that wants to be in this industry and in this space. It's very hard to do and replicate the scale that I talked to you about before. Our average market footprint at a minimum is about 5,000 homes per market. And we have thoughtfully gone out and tried to develop strategic partnerships, whether it be with home builders or with, call it local operators or opportunities to continue to grow our portfolio in a meaningful way, but do it in a responsible way that focuses on an exceptional experience for our resident and also focuses on making sure that we're focused on an environmentally friendly approach and a socially responsible approach to being a good neighbor. We want to lift values in neighborhoods. We want to do things in our homes that are, carbon neutral, things that are simple like hardscape landscaping. We have a program, for example, that when people come into our homes, we have a smart home technology with smart thermostats. So as a resident, you can go in and out of your home on your iPhone, and we make that mobile experience really seamless. But in addition, we also drop ship you filters every 90 days to your home so that the quality of the air in your home and what we're doing for the environment are also things that are meaningful. And over the law of large numbers, meaning 80,000, we have an opportunity to make a real impact. We think about it the same way that we do with pest controls. We think about it in how we create an experience for our residents with their pets. Are there things that we can do to make that experience that much better? And so it's a really exciting time to be Invitation Homes, where we've got this tremendous business with nearly a $20 billion market cap, a very transparent business in terms of what we do day in and day out to make the value proposition both meaningful for our associates, our residents, and our shareholders, and a tremendous amount of blue sky in front of us in terms of where we can grow. Today, we sit at 80,000 homes across 16 markets. We believe, if you look at like our Atlanta market, that all of our markets could look and feel like Atlanta over time. Atlanta is truly, a trophy for us in terms of how we view the portfolio, but we'd love to see similar growth profiles across some of our other MSAs. And it just takes a methodical, long-viewed approach to be able to get that, to be able to acquire that type of scale in the right parts of markets where we can continue to make sure that we create opportunity and supply for the existing housing demand that's in front of us. We're more active in the acquisition market than we've been in years. We've announced things like JV partnerships with specific partners so that we could bring additional housing opportunities into markets like Atlanta. We look at, some of the favorable fundamentals you guys see in your own footprint, and you're probably seeing it across your business. It is a great time to be building a business, not only in housing, but across the spectrum in a market like Atlanta that is very favorable to people that want to come, build a career, build a housing footprint or a family footprint, and really, create your own personal success story in Atlanta. And so with that, I just want to thank the Economic Council Club for having us. We are a company that's hyper-focused on being active in your communities. We want to continue to invest capital in the Atlanta market. We take our responsibility as a neighbor in your communities very seriously. It's one of the reasons why our residents continue to renew 75% of the time year over year. They love the Invitation Homes experience, and we're trying to create ways to engage shareholders in your community in meaningful ways, whether it's through the support of minority-owned businesses and creating opportunities for other vendors in your market and additional job opportunities, both with their own companies or with us at Invitation Homes, or getting more active locally in your market and working in and around areas like open spaces. Our team this last week was in Phoenix, where we've made a commitment to help build another 30 miles of walking trails and bike paths and a $150,000 commitment to a group that's based in Phoenix. We're looking to do and make similar commitments in markets like Atlanta, where we can be more active and where our associates and our residents can also play a part in serving in your community in ways that not only benefit our residents or our business, but benefit the greater Atlanta community as a whole. And so I'm grateful that you guys are having us here today to talk a little bit more about our business. We wanted to make sure that we leave plenty of time for Q&A. So thank you for having me today, and I'm happy to answer any questions you all may have.
Thanks so much, Dallas. I just wanted to start going into the Q&A. We have a couple questions coming from the audience. The first one talks a little bit about Invitation Homes and your business model. Given you guys skill and infrastructure, have you ever considered a prepaid all maintenance service for homeowners?
That's a great question. So here, we almost do all of that today, plus or minus, and I'll explain. So we have a system called ProCare. It's been a little bit, I don't want to say derailed, but the way we approach ProCare has had to change during the pandemic. But basically, when you lease from us, we go through about a 2-hour upfront move-in orientation with you. And we go through all the heavy mechanicals and everything that fits in the home. And then anything that happens in the home from natural wear and tear, that's on us. We cover all that today. So if you have a water line go bad, if you have an HVAC unit that goes bad, if you have a roof that starts leaking, we cover all of that. Your only responsibility is to return the home to us at the end of the lease in a similar fashion beyond normal wear and tear that we gave you the home at the beginning of the lease. Now, over the life of that lease with ProCare, the other thing we do is after we move you in and we go through kind of all the heavy mechanicals, we give you a fridge list, which is really simple and it's digital. And what you can do is we say, hey, anytime somebody moves into a new home for the first 30 days, you're starting to figure some things out. You may find a doorknob that's a little loose that you'd like us to address. Put it all on this list. And right then we schedule with you that 45-day visit so that we're back on property, touching all of that small stuff early on. And then our commitment is that even if there isn't an issue, we are gonna come into the business or come into the home every 6 months to make sure that the homes are in the appropriate fit and finish standards, and that we're making sure that we're aware of any and all issues that could be in the home. In addition, we do have a program for our residents that continue to release and stay with us for a long period of time, where we offer upgraded packages. So we have a couple of opportunities around upgrading kitchens, upgrading master baths that fall into our RevX program. And so very often, and this is an early program that we've rolled out, but we've done almost $30 million of this over the first couple of years. We have residents say, hey, I love my home. I have no interest in leaving, but I'd love to upgrade my kitchen. And we have programs for our residents where they can opt into that and can also help us with those programs. So I think we've basically got an end-to-end product that people can, be worry-free about. We call it a worry-free experience. We want people to move in, and we take the burden of home ownership and maintenance off their hands.
Thanks so much. A second question, I guess, deals a little bit more with the pandemic and the experience there. I was wondering how you guys navigated around the rent moratoriums and sort of the restrictions on evictions and things of that nature during the pandemic, which were instituted, to sort of help struggling renters.
Yeah, no, absolutely. So when the pandemic started late last spring, or early spring, we should say, we immediately went into obviously following all protocols that the CDC and other state moratoriums have put in place, and we still follow those to this day. And so we support anything and everything that the different states and also at the federal level have put forward. But we also created programs and different structures for our residents who needed to defer payment based on hardship. And that was really before even the CDC came out with their hardship letter that people could file and push on any rental collections. And look, guys, at the end of the day, we want to be a good steward of capital and be a good steward in neighborhoods. There's a reason why our residents renew 75% of the time and almost 2 times as much as multifamily. It's because we do offer a really good service and we care about, where our resident sits in their experience. Our mission statement is, together with you, we make a house a home. So we've erred well above and beyond, call it the caution that any state moratorium or any CDC moratorium is put in place. But every residential landlord, including mom and pops, should be adhering to those specifications as they've been laid out appropriately in both the federal setting and also at the state setting. And in the early days, it was really tricky because it was changing so frequently. So we just erred on the side of caution and basically for several months weren't really renewing at any rates that were beyond flat. We're still not doing that in some markets. But as market conditions started to normalize, we tried to allow the market to behave as normally as it could, but offer special attention and care to our residents that had any hardship. And we're still doing that to this day.
So I guess a little connected to that in terms of how COVID has affected the things that you're seeing in your industry. One of the things that my company typically looks at is sort of this move away from cities towards more suburban areas as sort of remote working becomes more of a viable option for people. I mean, if you kind of consider that a lot of the reason why people live in the cities is because they have jobs that they commute to that are located there. And I was wondering if you noticed any kind of pattern of increased move towards suburbs or increased interest just to kind of get away from the cities now that option to work remotely has been sort of an emerging theme during the pandemic.
Yeah, it's a great question. It's one we get from investors quite a bit. We've certainly seen in our surveys some of the feedback on move-in surveys that, hey, I'm looking for more space, or I'm looking for an ability to work from home. And those, call it from a response profile, have come up in maybe a little bit more greater detail than they had historically. But generally speaking, 9 out of the 10 responses would be looking for things around like, hey, I like this school district. Hey, I like the fact that I had a fenced yard for my dogs. Hey, I wanted a home that had a 2-car garage and I'm moving from multifamily. I would expect that we've gotten a little bit of tailwinds from that urban to suburban flight that probably happened around COVID. But again, back to my earliest points, pre-pandemic, our occupancies, both our company and the industry at large, were pushing close to 97%. So while you might lose some of that suburban back to urban maybe mentality, if there were some short-term decisions that were made, we'd be prepared for that. And we would expect that normally. I think, if you think about Atlanta, guys, and your market is really unique in this, that you have downtown, you have Midtown, you have Buckhead, you have areas like Marietta that are morphing and creating kind of what the phrase has been coined, suburban urban. You guys have all these really cool kind of urban kind of environments that are being built now, even in suburbs like Alpharetta and some of your newer markets. It's happening in Gwinnett County in some of these markets. It's really interesting. So as we've started to look at like housing fundamentals, what people are wanting to do in neighborhoods and why, it's interesting because that urban to suburban mix is starting to change, and developers, as well as community leaders, and as well as like retailers, restaurants, they're all starting to create these urban environments in suburban areas, which is a big draw. North Carolina and Atlanta, I think, are 2 of our markets where if you look at some of the suburban communities, they're starting to create denser opportunities for investment and also for living that aren't necessarily downtown. And as you guys look at what you've done with the different rings on the freeway systems, and also with the way MARTA moves in and out of the city, you guys have created a lot of little economic centers that aren't necessarily urban. And so I think it's pretty interesting to see how, as some of your bigger MSAs continue to evolve, what is that going to mean for housing? Because a lot of your suburban neighborhoods are getting, by no kind of work of their own, closer to more urban investment opportunities that are centered around them, which will create greater density. So we'll continue to monitor and kind of capture some of that in our own data, but nothing in there that's suggesting that we had a wholesale shift one way or the other. And it's still early on. We're only a year in.
So just a quick follow-up to that. I guess my question would be sort of how permanent do you think that kind of thing is? Like the trends that emerged during the pandemic, and we're now getting to the point where we're moving sort of into the end game of the pandemic or into a post-pandemic environment. So I was wondering, what your views are on sort of how permanent some of those trends might be, whether or not there might be any reversal in those trends. I mean, there was an interesting slide you had on sort of the cities that lost out during the pandemic, where people were moving from, whether or not you see any of that kind of reversing.
No, it's a good question. Christy, if you wouldn't mind pulling up that slide. So, first and foremost, I think we are seeing some shifts across, millennials. And I'm seeing a couple of the comments that people want to hear about, a little bit more data, and I'm happy to share. So taking a step back, guys, our average renter today is 39 years old. They make a combined household income about $110,000. About 8 to 10% of our portfolio every year cycles into home ownership. So if we renew 75% of the time, that means 25 to 30% of our customers are leaving our business some year for a variety of reasons. Those numbers have all been pretty consistent, but about 25% of the 25% is into home ownership. So call it 8 to 10% of our portfolio. The other reasons are for basically things like job relocation, change in marital status. I needed a bigger home down the street. I'm leasing from somebody else, whatever. But that data has all been pretty consistent. The one bit of data that continues to suggest that a flexible leasing structure will make a heck of a lot more sense is that younger demographic cohort, which is the millennial cohort. If you're born in 81 to whatever it is, 94, 95, you're considered a millennial. And that's a 65 million kind of person category, right? And so if you look at those trends, what are those folks doing? They're doing things with this. They're trying to stay mobile, right? They want to do things to be down payment light. They don't necessarily want to put $50,000 or $60,000 down on a $300,000 home. All of our survey data is suggesting that there is a shift there in that cohort. People like me in their 40s or 50s, they're probably a bit more prone to wanting to look at maybe an ownership option. By the way, when you look at where rates are right now, the balance of power with cheap rates, in theory, has shifted to homeowners to some degree when you look at a total cost proposition to whether you would want to lease or whether you want to own. Now, back to your question about where we see some of that imbalance. In our markets in places like LA and San Francisco, it's far more affordable to rent today. In places like Seattle. But when interest rates get really cheap, what you typically start to see is the inverse of that, where you can start to argue that home ownership could be as, call it equally of balance over a period of time. But when you get rate creep and when treasuries are moving like they are now at 175, you start to see that the opportunity to lease becomes a far more interesting value proposition. So in our business, the way to think about it is when we can do this obviously across scale and we can procure at a much cheaper cost, we spend about $3,000 to $3,500 a year on our homes and maintenance, in general wear and tear, upgrading things, et cetera. As a homeowner, I typically am spending a lot more than that on my homes. And so the value proposition there on the leasing side, at least in our segment, call it $250,000 to $350,000 home is much more affordable.
So sort of connected to that, I just wanted to touch on this idea of millennials and sort of the preferences of that demographic. I was wondering if this environment of just historically low interest rates, if that was causing any kind of shift in attitudes towards wanting to buy, or even if you wanted to, if people were starting to investigate things like renting to own, or things of that nature. I mean, if you consider that money is pretty cheap to borrow these days, and there are programs that spout up for sort of first-time home buyers, whether or not you're seeing any kind of movement, any kind of shift in preferences in that way.
We're not seeing a shift in preferences. We're just seeing, really a shift in supply. And so if you think about the FHA borrower that's say 3 to 5% down, that price point is generally on the lower side in terms of aggregate pricing. And I don't know off the top of my head. I apologize. I don't know what that is for Atlanta, but it's probably somewhere between $250,000 and $300,000, maybe 275 is where you start to top out from an FHA perspective. And so what you are seeing is that affordability factor, even amongst home builders. There's some real interesting charts. I'd be happy to send them to you. If you look at where, call it entry-level pricing has gone with public home builders, because their data is all public, just like ours. All of our data that I'm talking about is all public information. If you look at where average square footages have gone and where average price points have gone, you're starting to see that in entry-level product, square footages are getting smaller and pricing is going up. And that's for a variety of reasons. One, to build affordable product, and think about a market like Atlanta, where can you even build affordable product today? You probably have to be almost as far, without some sort of a state or government subsidy, you probably have to be almost as far west beyond Duncan, or as far east, you're going to get out pretty far, call it east, southeast of, if my counties are right, that's either DeKalb or Cobb in the southeast. So my apologies if I got that wrong. But you've got to be probably almost an hour and a half out of city center to start to build that affordable product. There's builders like LGI, Lennar, some of these other public builders that are doing a lot of this out there. But then again, you start to have that question, where are the jobs? More of the jobs are going to be closer to your rings off 75 and 85 in Atlanta, where you can drive, the right kind of traffic counts to businesses if people aren't working remote. And so that's where I think we'll start to see the balance of power shift, maybe in some of this entry-level product, or where we might see more availability. If the swing of the pendulum allows people to work from home longer, I think we're going to see more of those affordable products being built, maybe a little bit further out. And you're going to start to see the take rate on those homes be very active. And I think builders will do really well, meaning home builders. If the balance of power over the next year or two shifts back to people maybe moving more back into the office environments and things like that, I think you're going to see multifamily, people that are leasing like us that have infill product continue to have really strong demand for their products. So I do think interest rates come into play, but I think Fed Chairman Powell has been pretty clear about the fact that they want to see rates stay low for the next couple of years, and it's obviously going to create additional opportunity for people to buy, which again will continue to move pricing and rents really higher over time and distance.
Thanks. So I just wanted to circle back to one of the earlier questions about how you guys were dealing with eviction moratoriums and things of that nature. One of the attendees asked, so what percentage of renters from imitation homes are facing this kind of hardship?
Well, one way to answer it is just, I can tell you through our numbers, which we disclose every quarter, and we'll disclose again. We have an earnings call next week, next Thursday. So our business normally, call it pre-pandemic, we would carry about 50 basis points of bad debt meaning people that can't pay, aren't paying. And that's kind of normal. That's ordinary course. It's been that way since we went public in 2017. And it was really in the same brackets before that. Today, we've been carrying somewhere between 2 and 2.5% of bad debt as part of, call it, the pandemic related assistance and forbearance where we're working with folks. So, look, probably 75 to 80% of the time, most of our residents who have had a challenge just through restructuring payments and pushing things out and really working with people, we've been able to solve those problems. And we just continue to work with them really at their discretion. The other, call it 25% that have been really in a hard spot, so long as there's true hardship involved, we're just working with them and pushing that out. We're also helping them get access to some of the federal programs that are in place and some of our own programs internally that are available. So I would say it's, the bad debt piece of it for our business at 250 basis points has been, 4 to 5 times probably worse than normal. But we're even, we anticipate that we'll start to see that ease over time and distance.
So that was my next follow-up is sort of, have you started to see that begin to come down? Especially given sort of the recent stimulus packages that were passed and things of that nature.
I think it's still too early. There's a lot of stimulus in the marketplace. I think we'd all agree on that. We certainly see stimulus help some of our residents. That's been viewed as a net positive for those that had struggled, but we're also adding back, quite a few jobs, albeit not as quickly as we'd all like from a macro perspective. And certain industries have been hurt more than others. But I think that's why it's really important that you kind of know your lane. For example, guys, our average rent today is about $1,900. It's at a much higher price point than some of our peers. We have other peers in our space that are at $1,400, $1,500, $1,200, where maybe some of those jobs may be more impacted than maybe our own resident base. But we've certainly had an impact. Like I said in my opening remarks, 2,000 to 3,000 of our families have been impacted. We've been working with them. I think time will tell as jobs come back into the workplace, as things begin to open back up, especially around retail, hospitality, travel, et cetera. It feels like some of the key sectors that are still hurting a bit. And some of our folks do work in, those segments. And so I think we need to see more activity in and around some of those specific sectors so that, those numbers will start to normalize. We would expect, and it's our expectation, that over the next year, some of the bad debt that we talked about hopefully will start to subside, but it's still pretty early.
So just one last question from the audience, and I think you've touched on some of this already. When looking at the Atlanta market, sort of what's the price point that you're targeting, and up to what price are you purchasing homes?
Well, there's a lot of different, submarkets within Atlanta that we own. I mean, and I don't know if that we even showed a slide on here, but we have a lot of homes both south and north of the 20. We just looked at an opportunity in the southeast part of, call it Atlanta. We love, everything that's around the ring. Like I mentioned before, both the 75 and 85 are great transportation corridors for people with work and jobs and schools. But I would say kind of, our average price point in Atlanta is probably anywhere from a $250,000 to $350,000 home. And we're pretty open-minded as to which submarkets and why. There's a lot of great reasons to live in Atlanta. And it's a really awesome market, really diverse economy, as you guys know. And there's a tremendous demand for quality housing in markets like Atlanta. So we want to continue to find ways to invest, capital in a meaningful way and be a good neighbor and a good partner. And find ways to work with, the 170 plus local vendors. I mean, we did, I think the statistic we put on the board is in the last 9 years, we spent $400 million with, our local vendors in the Atlanta market. We employ 150 people. It's an important market for us, and we want to continue to be as active as we can.